Does Ireland offer a non-dom tax status? Does Ireland compete with the UK for my taxes in 2025? How do I become a non-dom resident in Ireland? And what will be my taxation? We explain all this to you in this video. Hello, this is Ban the Tax. In today's video, we will explain how Ireland can be a strong tax residency for you, for personal tax as well as corporate tax. We will explain: what are the tax brackets? What are the tax rates? What are the tax exemptions? Does Ireland offer a non-dom tax regime? How can you benefit from this status? And much more. We will show you how Ireland can highly compete with his neighbor, the UK, this year in 2025 and beyond. Let's dive in. When people think of Ireland, they often lump it in with England or just call it part of the United Kingdom. But while Ireland and the UK share a language and sit side by side on the map, that's pretty much where the similarities end. Let's clear up a common source of confusion first. The island of Ireland is actually divided into two parts. Since 1921, you've had Northern Ireland in the north, which is still part of the UK, and the Republic of Ireland in the south, which is a completely separate independent country. That split came about through the Government of Ireland Act in 1920, which originally aimed to create two self-governing regions under the UK umbrella. It even included a vision of possible reunification someday. The Republic of Ireland, as it's also known, has its own government, its own laws, and yes, its own tax system. Meanwhile, Northern Ireland follows UK rules and policies. In this video, we talk about the EU member, the Republic of Ireland. So, why focus on Ireland now? Well, it's a country full of surprises. It might not always be in the spotlight, but it's quietly climbing the ranks. In fact, in 2023, Ireland was ranked 4th in the world in the IMD World Competitiveness Yearbook, a huge nod to its global strength. Here at Ban the Tax, we're all about helping you understand how places around the world can benefit your financial and tax well-being. So, let's jump into what makes Ireland such an attractive option in 2025, especially when it comes to taxes. Benefiting from the Ireland's tax system means that you become a tax resident, and, as a tax resident, you can take advantage of the non-dom status offered here too. So, what is residence and what is domicile? Residence. Your tax residence refers to the number of days that you have been present in Ireland. First, there is the 183 days rule. If you spend over 183 days during a calendar year, you will be treated as an Irish tax resident for that year. In addition, if you spend an aggregated 280 days in Ireland over 2 calendar years, you will be treated as tax resident in the second year, provided you spent at least 30 days in Ireland during both years. Tax domicile. If you are resident in Ireland but non-domiciled, you can benefit from significant tax exemptions on your foreign income under Ireland's tax regime. And it is still valid in 2025 as opposed to the UK, who just abolished this tax regime this month after 2 centuries. Essentially, while you are liable for Irish tax on income and gains sourced in Ireland, any foreign income and gains you earn outside of Ireland are only subject to Irish tax if you remit them into the country. This is known as the remittance basis of taxation. As long as you do not bring your foreign income or gains into Ireland, they remain untaxed in Ireland. Importantly, there is no annual charge for claiming the remittance basis, unlike in some other jurisdictions. To fully benefit, you should carefully manage your accounts to avoid mixing Irish and foreign funds, and seek professional advice to ensure compliance with relevant rules and anti-avoidance provisions. Does Ireland offer a non-dom tax regime? Yes. As explained, Ireland offers a favorable non-dom tax regime similar to what the UK had before April 2025. This means that, if you're tax resident but non-domiciled in Ireland, you can benefit from the remittance basis of taxation. That's the typical remittance basis, which means that your foreign income and gains are not taxed in Ireland unless you bring them into the country. There is no cap on the amount you can keep abroad and no time limit on deferring remittance. Furthermore, the funds earned before becoming an Irish tax resident can be brought into Ireland tax-free. But here you must be careful on how to split those funds and not mix them with the funds that you earn after becoming tax resident. Quick pause, support our channel. Before we continue, can we ask you a small favor? If you're finding this video helpful, please subscribe to our channel and give us a thumbs up. It really supports our work and helps boost our visibility across social media platforms. Thank you. Back to the video. How to benefit from Ireland's remittance basis in 2025. There is no particular application for this regime. Concretely, you must use your tax return, Form 11. We have added the link to that form in the video description. In this form, there is no specific box to apply for the non-dom status. The revenue will assess this right for you based on your residency, domicile status, and remittance pattern. So, what you have to do is just report your Irish source income and any remitted foreign income on your annual tax return. It is usually done online via Revenue Online Service, ROS. The foreign income and gains that you have not remitted in Ireland don't have to be reported. As you see, in Ireland, they don't bother you with what you have outside Ireland as a tax resident. They just ask you to declare what you have in Ireland. Other countries in general require from you to declare everything you have inside the country and outside. Ireland does not. To make the most of this tax exemption, keep foreign and Irish funds separate. Use clearly structured bank accounts to avoid accidentally triggering tax through mixed remittances. There is no annual charge to claim the remittance basis, unlike the UK's former system which imposed fees. Be aware of capital acquisitions tax, CAT. Gifts and inheritances are subject to 33% CAT. Non-domiciled individuals become liable for CAT after 5 consecutive years of Irish tax residency, with taxation starting in the 6th year. What are the taxes in Ireland? Let's start with personal taxes. This year, some really positive changes came into effect. The standard income tax band was increased from €42,000 to €44,000. What does that mean for you? Well, it means more of your income is taxed at the lower 20% rate. That's a good thing. And there's more personal tax credits like the personal credit, employee credit, and earned income credit have each gone up by €125, now sitting at €2,000 apiece. That effectively raises your tax-free income. Plus, the universal social charge, that's the US CHAS, seen a cut from 4% to 3% on income up to €70,044, another helpful reduction in your overall tax burden. And here's a big one. If you earn under €20,000 per year, you won't pay any income tax at all. You're outside the income tax net. Now let's turn to business taxes. Ireland continues to shine when it comes to company taxes. The corporate tax rate is still just 12.5%, of the lowest in the entire European Union, together with Cyprus, Hungary, Poland, or Bulgaria. It's no wonder multinational corporations love it here. If your income comes from patents or intellectual property, you'll enjoy an even better rate, just 6.25%. That's a serious incentive for innovation and tech-based businesses. Ireland also rewards companies that invest in research. There's a 25% tax credit for research and development, and yes, even if your company is still making losses, you can claim it. Now, the big question is, does Ireland compete with the UK as taxation is concerned? The answer is yes. And for both personal and business income, here are the main tax reasons why you would choose Ireland over the UK. Let's split these incentives into personal and business taxations. In Ireland, while there isn't a tax-free allowance in the traditional sense, individuals earning up to €20,000 annually can effectively pay no income tax. This is due to the application of combined tax credits. This means that the two tax credits together for personal and employee will give you €4,000 in credits. And these credits will offset the tax liability on the initial €20,000 of income, resulting in no income tax to be paid. In contrast, the United Kingdom offers a personal allowance of £12,570, meaning income up to this amount is tax-free. Earnings above this threshold are taxed at the basic rate of 20%. Therefore, an individual earning £20,000 would be taxable at 20%, leading to an income tax of approximately £1,486. We can say that a rough number of £1,500 is due in taxes in UK on approximately the same income, whereas no tax will be due in Ireland. Additionally, Ireland's standard rate tax band has been widened. As of 2025, the 20% income tax rate applies to earnings up to €44,000, an increase from the previous €42,000 threshold. This broader band allows you to earn more at the lower tax rate before jumping to higher rate of 40%. While currency exchange rates can affect direct comparisons, we can see how tax liabilities can vary significantly in both countries based on income levels and applicable credits. Business. Ireland's 12.5% corporate tax rate is world famizon lower than the UK's 19 or 25%. This is especially attractive for SMEs and startups seeking tax relief and for holding companies with international operations. Also, the IP and R&D incentives, giving 6.25% for income from patents or software IP, and 25% R&D tax credit, even for loss-making companies, could be real incentives for this segment. Not to forget the currency and access to EU market. If you earn or spend in euros, living in the Eurozone may offer advantages for the payment of your clients in euro. Conclusion. We only covered here the non-dom advantages and income comparison with the UK. There is a lot still to cover to give you full picture for a complete comparison, Ireland, UK. For example, the dividends, that are less taxed in the UK. There are also quite a few tax incentives for startups and SMEs in Ireland that the government has introduced or intensified this year, in 2025. We will cover these very interesting topics soon. Stay tuned. In this video, we wanted to highlight essentially the non-dom status, still offered in Ireland, and not anymore in the UK. There is absolutely no limit in time if you want to become a resident under the non-dom status in Ireland. Many of our UK-based clients ask us which other non-dom country they can go to. We made already a video on Cyprus. We also offer a free document where you can find a full comparison Cyprus versus Malta in 2025. You can ask this document for free through our blog or through the link in the description of this video. We hope this video has provided some clarity or at the very least, raised important questions about your alternatives to the UK non-dom regime. If you're exploring ways to minimize your tax burden, Ban the Tax is here to guide you. Send us an email at info@banthetax.com. We are eager to hear from you. Before leaving, please subscribe to our channel and give us a thumbs up. It really supports our work and helps boost our visibility across social media platforms. Thank you.